Negative electricity prices and restrained demand growth are pressuring generators in the Nordics. Today's challenging market sees supply-side actors reassessing their strategies. Better positioning for long-term developments calls for a close eye on opportunities that are less than obvious. You're listening to Energy Bites with ELS Analysis. Welcome to this week's episode.
Welcome to this week's Energy Bites with ELS. This is our 14th episode. My name is Carl Rosenberg, back as your host, filling in for Elena Kinsey as she is in Copenhagen with Samuel for the annual Wind Europe conference. With me today, I have Siddharth Aya, our market analyst. And for the very first time, joining us today is Henrik Lindsjö, senior partner and technical advisor for both our project with ELS Analysis and the ELS Analytics platform. Welcome to you both.
Hello.
All right. Today, we're unpacking the surge in negative electricity prices in Sweden, a trend now even hitting hydro producers who are struggling with squeezed revenues and limited dispatch flexibility. And with flow-based market coupling newly in place, and this being the very first summer under this new system, we're going to be driving into what is causing this volatility, where the bottlenecks lies, and what it could mean for the producers going forward and how to remedy it. In 2024, Europe saw record levels of negative electricity prices, and in particular Finland and northern Sweden, most notably in SE2, prices dropped below zero during more than 8% of the year. This was largely driven by strong wind and hydro output, weak demand, limited export capacity. And in Sweden, a wet spring filled hydro reservoirs, and in Finland, the situation was made even more extreme with the addition of Olkiluoto 3, so further tipping that supply-demand balance. But I thought I would give both of you guys the opportunity to sort of describe the current state of the electricity market. So starting off with you, Henrik, how would you describe the Swedish electricity market?
I mean, what you read in the news is mainly complaints about the high prices in the south, and also short, very high price peaks are getting a lot of attention. But I mean, the actual problem is not that. Obviously, people are surviving. I know it can of course be tough, but the real problem is that in SE1 and 2, it's virtually impossible to invest. The prices are so low, and the demand side outlook is not becoming better by bankrupting Northvolt, and also discussions on other large off-takers of electrical energy is like floating up in news media. So it's definitely a challenging situation, and it's not really easy to understand either why we're getting these low prices. Who would like to produce on negative prices? But still we get them, and they can go quite deep, surprisingly deep at certain periods.
What about you, Sid?
Right. So, as Henrik correctly pointed out, there's very low prices in northern Sweden, but at the same time, very high prices in southern Sweden. And the introduction of flow-based market coupling has not joined these two and resulted in a more unified price. Despite better utilization of the grid and less congestion, as it were, between the zones, the price differences are higher than ever. And of course, producers in the north of the country are squeezed. They're not able to export power to the south at a price that works for them, and that results in lower profitability over time. Now, why they are bidding at such low levels, that historically has been due to guarantees of origin and renewable energy certificates of that kind, but the price levels now are the negative prices are more negative than the prices of electricity certificates, essentially. And this could be driven to a great extent by a lack of flexibility in some producers, whether that be intermittent renewable producers like solar and wind, or cogeneration plants that are fired by biomass, which need to keep running in order to produce heat. Many reasons that lead to a lack of flexibility, which where producing at a negative price is still considered better than not producing and feeding into the grid. But that said, the structure of the market is not as transparent as it needs to be, especially in the flow-based regime, and with the implementation of automated MFRR activation on the balancing markets, which has led to extreme price spikes, and often the balancing prices not being visible to players at the time of balancing, and then them being aware of the extreme price they have to pay only after the fact. So despite better utilization of the grid, there's less transparency. That said, I would like to point out that the low prices in the north of the country are an opportunity for the demand side to pick up. And we've had quite a lot of discussion on this, and I think we'll come back to it later on. But the state of the market right now is with suppliers in the north being quite pressed.
You make a couple of great points, Ed. Also mentioning the grid there. I thought I would ask you both, to what extent are negative electricity prices caused by production patterns? That's often what we hear in the general debate, versus the limitations in transmission capacity between Sweden's price zones.
I think this is a combination. There are some really odd. I mean, I know of one company who has like 1 foot on the supply side and 1 foot on the demand side. Their unfortunate in this case is that they have their production in SE2 and they have their consumption in SE3, and they're like, it's a heavy industry. So they're paying congestion fees for themselves. Like, they tried to hedge by owning their own production. This is historical reasons, and now they're stuck in this price area split through the country. So it's definitely a combination, but also if you look at the supply side, wind and solar are getting blamed for the low prices, and to some extent, of course, it's pushing the total supply. But I see few reasons for wind or solar to even bid negative. There is no reason for them. They could just pull the plug. But there are, like Sid said, there are other producers. Like, you don't shut down a nuclear reactor for even 1 day of negative prices. It has to be much more. It will take them a lot of time to get back on the grid again. And the same could be the case for some other sources. Hydropower to some extent, but I also doubt they would bid negative. They could. I think in one case they could bid negative, and that is if you have high prices on ancillary services at the same time. Then it would make sense. You have to get rid. You have to, if you bid FCRN, which is a symmetrical product, you have to be able to regulate up and down. Then you have to operate in a certain point, and that energy you have to get rid of. And the revenue from the ancillary services could be enough to well pay for the negative prices. But I think that's still a marginal thing. There is something else happening. But like Sid said, the transparency is virtually non-existent. So it's very difficult to find out what is actually driving these negative prices.
Any thoughts, Ed?
Yes, absolutely. So the transparency part is very much the case. Like, the grid utilization should be much better under the new flow-based market coupling system. And it is, but that still does not result in prices being unified across zones. The changes being implemented into the system are not any longer working out for market participants to really know what it is they're selling and to whom. That said, many are still looking to secure PPAs to try to make the situation a bit more transparent for themselves, like by having specified offtake price. But the system is more and more evolving to make that difficult to plan ahead for. And the stacking of multiple changes at once is exacerbating the issue. While, yeah, market players are not really given the tools which are needed to plan for a real transparent market, the way that more traditional energy markets, such as oil and gas, there aren't negative prices in those markets, and those are driven by mainly three things. One is a sort of minimum level of price, a minimum cost to produce, which props up the price at least to some extent. The second is flexibility. A producer of oil or gas can, of course, store it, but they can also sell it to any off-taker anywhere in the world, as long as they have ships available to transport it. The third thing is transparency, and price formation in these markets is very much clear by clear signals from OPEC, in terms of how much they plan to supply, as well as fairly certain demand patterns as well. So these factors, the flexibility, the transparency, are not to the same extent there in power markets. And while there has been transparency to an extent needed up to now, that's no longer sufficient.
You mentioned the oil and gas markets. If one compares the fossil markets to the power markets, the oil and gas producers typically operate with a price floor, a level they can reasonably expect not to fall below, and that is a result of certain market structures and dynamics. What mechanism create that price floor, or rather a corridor of expected price levels? And could something similar exist in electricity markets, or are they inherently more volatile by design?
Yeah, so on the oil and gas side, the corridor is mainly because there is a non-zero cost to produce oil and gas. And no one will bid on the markets if they're not going to make at least that much. They also have the flexibility to regulate how much they are at least sending. In the power markets, that was the case while most power was dispatchable. And by dispatchable, that includes hydropower as well as cogeneration, gas-fired power plants, and biomass and waste-fired power plants as well. But as long as there's a zero cost to produce, many market actors are willing to bid at the lowest level possible just to have their production taken. And is there a solution to avoid this? Well, on the one side, it's increasing demand, consumption of electricity, ensuring that there is a certain minimum level of demand, and whether that comes from new investment from actors who are not in the market today, or investment from actors that do exist. In order to ensure a price floor, it's not something that market players can do individually, because those who bid under the price floor will, of course, win over those that decide that they won't bid below a certain level. In the oil and gas markets, we see OPEC, which sort of define a price, and in that sense it's a cartel. That's not something which flies in the power markets, especially given how regulated they are. Perhaps there are ways and means in order to amend the market design in order that all of the market players contribute to a sort of common balancing pool, which ensures that essentially everyone is given sort of a floor.
What do you think, Henrik? Any way we can achieve that price corridor in power markets?
I mean, then you're immediately starting to regulate, and let's say you establish a certain floor, then you won't match demand and supply anymore, as the market is designed now. I think it's not so simple within the current design of the market.
And negative prices should give that, strong signal for demand side to pick up, but we're not seeing that happening.
No.
Why do you think that is? What can suppliers do about it?
I think much of both the demand and supply side is related to like the hen and the egg. I mean, what has to come first? And the problem is that the lead times are very long. It's not like trading beaver skins on the local market. It's you have 5-10 years project time from initiation to connecting to the grid, independent if it is on the supply or demand side. And yeah, I think it's a risky business. And I've heard venture capitalists saying that they have no problem in taking risk. They can take very high risks. But there has to be an unlimited upside to take risk, because you know that you will place your bets on maybe 10 different companies, and one or two of them will succeed and the other will fail. You can control your downside to a certain extent, but you have to have a really high upside potential to cover up for your losses, because most of your investments will not be profitable. And what we see clearly is that there is a limited upside on the electricity price. It's politically impossible to allow prices above a certain limit. Then you will never be re-elected. And we saw it during the beginning of after the Russian extended invasion of Ukraine, that there were such support schemes in basically every country. And that's just to maintain, keep yourself in power and not just lose the next election. So yeah, I think that is one of the issues why we're ending up in this difficulty to long-term balance supply and demand. And that also means that when the system is not stable, I mean, from the design of the system, the system was designed and worked pretty fine to optimize an existing investment. There was huge investments made to build up these energy systems in transmission capacity, all the infrastructure, power plants, you name it, even competence. And then you have it and you want to utilize it as good as possible in fairly stable market conditions. You did not have many changes in terms of neither supply nor demand. And now we're into something totally different, which I think it was not really designed for from the beginning. And I think this time aspect of it all is very difficult to handle and manage.
I completely agree. Politics is inherently content with low prices for both households and for industry. And a separate question would be, what can market players do to remedy the situation themselves, sort of without harming their own competitiveness?
Yes, just drawing on some of the discussions we've had earlier about suppliers being pressed at the moment. There is a strong case to be made for starting to take positions on both sides of the transaction, not just remaining on supply, but also looking into the consumption side, that is, consumption of electricity in order to provide another service. So, of course, low prices are bad for supply, but good for demand. And having both facilities under one roof and able to optimize on them gives a certain advantage.
That's basically how Swedish hydropower was built once upon a time. If we exclude Vattenfall from that, much of it was built either by forest industry or other industries together. Steel plants, they build their own, they invested in their own production of electrical energy to, I guess, basically hedge. And then there has been, during this consolidation of markets and flat market development and cost pressure through deregulation, everything, they have been consolidated in a few large players. Vattenfall, Fortum, Statkraft, Uniper being the dominant ones in Sweden. So yeah, I agree. It could be time for like vertical integration, and to if you're a supplier, add off-taking, or if you're an off-taker, invest in production. that would make sense. It would require new thinking, and they might not be prepared for it. It's a bit disruptive for many, probably for many utilities, but agree. It's a stone which hasn't really been turned in the general debate yet.
Yeah, speaking of market reform and long-term strategies, there's quite a bit of a debate and studies on Sweden's electricity price zones, and we all know that SVK is looking into this. But could reforming these zones serve as a short-term and I guess a long-term game changer for the market? How might such changes impact producers, grid operators, and I guess the overall market?
We have had some discussions on it. I didn't think so before. There is a good reason for the price areas as they are now. They were designed to handle congestions, and well, that has worked, but slowly. And now we're also seeing discussions on, well, if you want to connect your wind park, you have to also be able to supply a certain bottom limit of production. Discussions on gas turbines. You build a wind park and you add a gas turbine to be able to always supply a certain amount of energy. Another way to do it would be just to drop that and say that, okay, we do it the German way. One price area for the whole of Sweden. One price. And what would happen then with congestions? You put this problem in the pocket of the TSO, Svenska Kraftnät in this case. And if they want to build a gas turbine for short-term operations in SE4, or if they want to add a cable more, add transmission capacity from north to south, it will be up to them, and they have to optimize the system from that point of view. It could be one way. You could easily see some potential deficits of that way as well, of course. I mean, it might lead to massive build out in SE2 and a massive consumption increase in SE4, which was not the intention from the beginning. But on the other hand, we are at the point where we're stuck, in what we have. It's preventing development, but on both supply and demand side currently, I would say.
So,
Yeah, of course. On the note of unifying into one price area, it would certainly be helpful for power supply to know what price level they can expect. At the same time, Finland is one price area. Germany is one price area, of course. Finland vacillates between high and low prices fairly quickly, and there are sometimes extreme spikes. Germany is structurally a high price area, perhaps driven by the fact that there's so much gas reliance there. But nonetheless, that is the case. And in Sweden, politically, there's been some foot dragging in terms of coming to a decision on what price area configuration is appropriate. It would result in a huge change to business plans that exist, no matter what they do, what the new price areas are. Like, for example, if SE3, where the high consumption is, pushes further into SE2 and has perhaps half of the area or a certain portion of that area, those that are in the new SE3 the suppliers would be exposed to much higher prices, while those that are in the old or continuing SE2 would be left out of that. And as long as transmission capacity between the zones is not equalized, essentially resulting in one price area de facto, that difference will be there. I think that might be to some extent one of a justification perhaps for leaving the decision for later. And perhaps the single price area in that sense would not be such a bad result for those who have made investment decisions. But then the onus is still on SVK then to solve the problems. It's just there won't be a bottleneck revenue which funds the wallet in order to fund them. But much of the measures need to be taken.
I think in the discussion in general, it's worth remembering also that the prices aren't high in Sweden, not even in SE4. I mean, the prices are low compared to Europe. Sweden is used to low prices, and it has been part of a strategy from the beginning to make sure that heavy industry could remain, and that's part of the wealth created historically. So served us well. But the prices are still not high in the south, and I don't think these price spikes upwards that we see now and then is really a huge problem. But the low prices are really a huge problem from an investment perspective, and to be able to get to the levels of production that are needed if any of the forecasts for the future with increased electrification will come true.
We are over time by quite a bit, but I don't think our listeners will mind. So I thought I would allow myself to ask one last question. In the general debate, we often hear that negative prices are a sign of oversupply, and it is generally the consequence of renewable producers such as wind and solar power. But inflexible conventional power stations are also responsible here. And as I mentioned in the introduction, Olkiluoto 3 has been tipping the supply and demand balance in Finland. What does this mean if the Swedish governmental plans with regards to nuclear come to fruition? Do you want to start, Sid?
Absolutely, Carl. So, well, yes, inflexible nuclear power can result in quite low prices when it's running, and it has to produce, and it'll sell at whatever price is available, because the opportunity cost for shutting down is a lot more than to sell even at negative prices in some cases. And if there's a huge volume of nuclear producing while the demand side, I mean, has not picked up, then that could result in continuing negative prices. And if looking at Sweden for now, if that all of that nuclear generation is under CFD, a contract for difference, then the government essentially will be paying that huge difference between whatever CFD strike price there is and a negative price. Of course, there might be mechanisms in order to, prevent payments during negative price hours, but still, then the bid would be at whatever price floor is decided within that CFD negotiation. Still quite a huge bill, unless the market price is kept high enough. And that is also not politically favorable. I mean, we see that there's willingness from the Swedish government side in order to fund nuclear production. But one, of course, the long lead times before that comes online is the point. But two, what about the meanwhile? Like, demand can't come online until supply is ready to come online. And then when supply is online, demand has nowhere picked up to the level necessary to keep things in balance. We see, as you mentioned, Carl, the effect of Olkiluoto dragging prices down in certain times of the year. That can very much be exacerbated with more nuclear build-out, unless there's a structural change.
Brilliant. Henrik?
Yeah, no, I agree with it. And there is, I mean, it's a quite sensitive system. I mean, what we're saying is that there is a price curve for the supply and a price curve for the demand side. And where they meet, you have the price cross, and that is the marginal price. But in electricity, you either need it or you don't need it, which means that the demand side curve is very steep. It's a bit rounded in the upper and lower, but then it's pretty much vertical. Which means that just a small shift of that one or a small shift of the supply side can have a huge impact on the prices. And I think that is part of what we're seeing in Finland now. So it's again this balance of supply and demand, which is a problem, and that has been a problem before. When the nuclear was built out in Sweden, they misestimated the growth. So there was a huge surplus of energy, which led to you had to get rid of it, and everyone building a house in, like, I would say late 70s and at least first half of 80s, all those houses basically were built with direct electrical heating. They had only electrical radiators because you had to burn the energy some way, and the electricity was so cheap. It's difficult to forecast and it's difficult to handle these risks, which means that, there are challenges when it comes to setting a market design to managing these conditions, and also the fact that the lead times on both supply and demand side are so long.
Yeah, this has been a great discussion. And as always, ELS Energy Bites closes with the segment what we're going to keep an eye on. I can start this month of April. On the 11th, the offshore wind inquiry consultation date will close. So we are definitely going to keep an eye out on what the responses will be from the different market players and industry bodies. And on the 25th of April, the electricity market inquiry will be handed over to the government. So definitely curious on what Bodis Falushi and the expert group has produced. I can throw it over to you, Sid. What are you going to keep an eye out for?
All right, Carl. What I'll be keeping my eyes on very much are the subtle signs of what capital is looking to invest in from here on out. Europe has shown itself to be willing to attract infrastructure investment for defense as well as many other sectors, and that's what I'll be looking for. Where is investment coming from?
Henrik, do you have something to add here?
No, not really. I think there was good points. I'm constantly fishing for developments of the price area discussion if something would show up, but I doubt that it seems to be cemented in a bit of feet dragging, like Sid said.
All right. A big thank you to you both. This has been a great discussion. All right. Goodbye until next week.
Bye-bye. Thank you. Thank you for tuning in to Energy Bites with ELS Analysis. To know more about our advisory offerings, email us at els@elsanalysis.com or visit our website www.elsanalysis.com. Follow us on LinkedIn to stay up to date on our latest activity. We wish you a good and productive week ahead.